Thank you very much, everyone, for joining us here on this Tuesday. Appreciate it, whichever time zone you're in, uh, on the West Coast or the East Coast, or over in Israel or anywhere in between. I wanted to thank you. This is our first reverse pitch event that we're doing here at the office. So this is kind of the opposite of what a lot of you normally do when you're pitching the investor themselves. We decided to kind of turn that on its head and let the investor go ahead and pitch you on why they're a good investor, what is their background, and really just kind of hear from the other side of the table. A little bit of housekeeping rules. So this is kind of how we'll do the format for today. You can use the chat feature down below to ask your question. If you want to raise your hand during the meeting, I can go ahead and call on you. We're going to try to keep this meeting as interactive as possible. That way, it's more of a discussion rather than a lecture. That'll make everything a lot more interesting for everyone here. I will keep you muted unless you do have that question. Of course, if you wanted to save your questions to the end, we can also do that as well. But I do encourage you to speak out and let me know if you do have a question during the event. That way it's more relevant to whatever topic that either myself or Arpan is talking about. And of course, we're going to have this conversation recorded for a future release. We'll just make sure everything gets finalized with that before we let it come out. A quick agenda before I make an introduction for myself. I'll go ahead and introduce myself in the office for about 5 minutes, and then Arpan will speak for 15 to 20 minutes, which will include your Q&A session, so that might last a little bit longer. We're going to max out the Q&A at the end at about 10 minutes. Afterwards, there'll be a slight break. And for those of you who I messaged about meeting with him afterwards, we've already set that up and you've confirmed, so thank you for that. And we'll move forward in a separate meeting room for them. And that will be the format for this meeting today. So this is our office. But before that, I'll go ahead and introduce myself. My name is Randall Fink. I'm the head of investment here at the office. So I work with venture capital firms, CVCs, hedge funds, LPs, anyone that's going to have any sort of extra money to potentially invest in a business. That's the person that I would work with. I also lead our fintech and enterprise initiatives. I've been working within the finance space for the past 5 years, so definitely have some expertise there. So overall, we have 45 offices globally, 4 within the US. So the big ones are obviously San Francisco and New York City, the 2 coasts. We also have a DC office, and then one in Houston that's really focused on oil and gas. Here on the West Coast, the main areas are California, Washington, Arizona, and the ones in bold there. That's where the majority of the activity that we do occurs in these states. However, it does encompass quite a few states, as you can see. So we have to have all 50 states covered for these 4 territories. At this point, I'll also mention who we work with. So for the organizations that we work with, a lot of you are familiar with the IEI, which is the organization that kind of employs us, and we work through the partner organizations. So we work on specific delegations to Israel for a lot of the industries that we work with. I cover enterprise and fintech, but we also cover every vertical that you can think of. So that's going to be cybersecurity, it's going to be retail tech, it's going to be consumer products, really any sort of category, ag tech that you can think of, we work with that. And this also allows us to join in all of the biggest events that occur, like MWC, which is happening in Barcelona at the end of this month, or CES, a very big conference in Vegas that occurs every year. So we normally get involved physically at these events, And since COVID is ending, we're definitely going to be looking to attend those events in person a lot more. Over the past 16 months or so, we've definitely done it virtually. We've definitely had a big presence at those events and any delegation that we've done as well. Our goal as an office is to attract investment from the market, including the West Coast, really, to Israel to create business on the West Coast. So we kind of act as that bridge, creating a gap, bridging the gap from Israel, the Israeli ecosystem, to the West Coast. And this is what all 45 offices do. They do it for their specific regions. They have that sort of list of warm contacts that they have worked with for quite a while, and that's kind of our advantage that we have as a governmental entity. People see us as that intermediary that's really a helping hand, and it's really advantageous for both ends to work with us, especially the startups, because they see us as able to help them in their go-to-market strategy, find relevant partners, whether that's investors, corporates, or customers, and work with them over an extended period of time. We kind of gauge where they're at, what their goals are, and try to make relevant introductions where necessary, whether that's in my office, or if I make an introduction to the New York office, or if it's another office abroad, we make sure that we get that going. And the biggest thing, like I mentioned, is using our warm network. So we have contacts at large banks, large corporations, US startups, and definitely a lot in the Israeli ecosystem as well. So it's not just the companies here on the West Coast that we utilize, but also the organizations and investors in Israel that we get in contact with, that we utilize to help everyone within our network. So that's going to be the biggest thing for us. At this point, I would like to introduce Arpan from VU Venture Partners. He is a former colleague of mine, and happy to go ahead and let him take it from here.
Hey everyone, it's great meeting you guys. I'll just pull up my presentation. Yeah, so like Randall mentioned, I don't want this to be like a lecture format. I want it to be as conversational as possible. So, feel free to stop me anytime, ask any of your questions. I'll be more than happy to answer those. So just before I go into my background, I first wanted to just touch upon who our general partners are. I think it's very important for founders to know who they are and what excites them, because they are the ultimate check writers. So for our fund, we have Skylar Fernandez, Andrew Zalcin, and James Zhang. Just a brief background on them. They combined have 45 years of work experience between them. They have kind of almost deployed $1.8 billion in the past 45 years. Skylar Fernandez was the founder of Cleveland Avenue and Simon Ventures. Andrew Zalcin ran RRE Ventures for about 25 plus years now. And James Zhang worked for SoftBank China and was the founder of Formation 8 Fund. Some of their key investments are Facebook, Twitter, Uber, Venmo, Oculus. And the reason for showing this is because these are definitely the best investments that are found, that our general partners have made. And what we want to bring up from this is that all of the things that I talk about later in my presentation of what we look for in a startup, they kind of come from, these startups have similarities to what we now look for in our new investments. All of these investments are from different geographies, have different business models, but there are certain characteristics of all of these startups that are very, very similar, whether it's the founder, the team, the product market fit, the go-to-market strategy. We have 3 offices, physical offices right now, one in SF, New York, Hong Kong. We have virtual people in Europe, Asia, other parts of Asia, and US. So going back to our core management team, I'll start with my background. My name is Arpan Ajmera. I graduated in mechanical engineering from Purdue. I started my own company called Plan for Me, which was a subscription-based business model aimed at the residents of Chicago to plan upscale niche activities. Got a small exit from that. I then went and joined ZX Ventures, which is a corporate VC arm of Anheuser-Busch InBev, the beer company. So if you guys have ever drank like Bud Light, Budweiser, Hoegaarden, those are some of our M&As, acquisitions. And then the rest of my team is here. I won't go into too much detail. So the VU Venture Partners, the VU stands for Venture University. And this is what makes us different from any other venture fund. Venture University is an 11-week program where we get people from all walks of life, from all stages of life who want to break into venture capital. And what that does is that a typical venture fund of our size of $100 million fund might have 5 people looking for deals. We have about 50 people looking for deals, and it's because of the Venture University program that we run. Who joins this program are, like I mentioned, people from all walks of life who want to join as an analyst, associate, or principal at a different fund, who want to launch their own fund, who want to professionalize their angel investments, who want to either start like a startup studio, startup accelerator, or even a corporate fund. But I guess most importantly for you guys is even entrepreneurs and founders join our program so that they are able to understand what VCs look for and are sitting on the other side of the table just to understand what an investment process looks like, how VCs fund, how do deals take place, and just even make a network within the VC industry. Again, going back to our added advantage, because of the VU in our name, Venture University, we're the most scalable venture fund. So instead of like the 5 investors that would be on a normal team, we have about 50 investors. We see almost 10 times more deal flow than any other VC fund of our size. And that's solely because of the number of investors that are in our program. We break our team. We have like basically 6 deal sourcing teams: consumer, enterprise, fintech, frontier, healthcare, and prop tech. And this kind of just summarizes every company that's out there. We are agnostic of stage, but most of our investments are focused within seed, Series A, and Series B. We'll put in from anywhere from $100K up to $1 million for our initial investment. And then 66% of our fund is saved up for our follow-on investments. So we are able to put in $10 million in the follow-on round of the company. We are pretty active investors. We invest in about 2 to 5 companies per quarter, which adds up to about like 20 companies per year. We have been active for just over 2.5 years now, and we have about 54 portfolio companies.
Arpan, I want to ask a question here.
Yep.
On the last slide. Can you just walk us through maybe the average check size that you do, but also the amount of time you spend in diligence looking at companies before you make a final decision?
Yep. Yeah, that's a great question. So we'll put in anywhere between $100K up to $1 million for our initial investment into the company. And then in a follow-on round, we'll do anything up to $10 million. In terms of like the diligence process, it really depends on like where the stage of the company is. So for an early stage company, we can do as fast as we can complete our diligence within 2 weeks. We usually, and that's mainly because we do not lead our initial investment. We only co-invest for our initial investment so that we can keep our diligence cycles smaller. But for the follow-on investment that we make, we may lead that round. And at that point, like the diligence becomes a lot longer, but it's also better because we have known the company for a while, then we have kind of developed a relationship with the founder. So it becomes easy to make an investment decision. But it really varies. Just to summarize my answer, it really varies anywhere from minimum 2 weeks, and it can take sometimes up to 5 to 6 weeks, just depending on how the round is progressing, who the other investors are.
Makes sense.
So right now we have a syndicate fund of about $100 million. We've invested in, like I mentioned, just over 54 companies so far. Our on paper IRR is 20%. We have had one exit called Made in Space. It was a company that was 3D printing parts in space, that exited mid last year. Some of our investments here, like Room, Wayflyer, Flowerco, we invested when they were just beginning out, like when they were at pre-seed to seed stage. They were at like 0 ARR, 1.5 million ARR, and they have like significantly grown in the past 18 months. And again, the point of showing the names of these companies and their growth is to summarize what I'll be talking next, which is what we look for in when we make our investment, and how we evaluate startups. So like I again mentioned earlier, we are agnostic investors. So we pretty much cover everything, but our teams are broken down into enterprise, consumer, prop tech, fintech, healthcare, and frontier. And every quarter, we think of a couple of verticals that we really want to focus on, where we want to make our investment. So for this quarter, we are really looking into bio ink and bioprinting space. We have already invested in 2 companies called Finless Foods and Integriculture in that space. And if you're not familiar with that space, that space basically entails 3D printing food in laboratories, or 3D printing milk, tuna, fish, different kinds of meat in labs.
I want to ask a question about I guess the companies when you found them, like what would be the best way you think for a startup to reach out to a VC, including yourself?
Yeah, that's a great question. So I think the best way is to get an introduction from another VC or someone else who knows the VC. That could be like if you know a founder who has been invested by VU Venture Partners, and you ask the founder, hey, can you introduce me to VU? The chances of you getting a call with the VC is much higher. You can ask for introductions, within your network, from other founders, from other venture capitalists, from your prior investors. There's of course cold reach outs. The only caveat I would say for cold reach outs is that make sure that you personalize the email to the VC. So not just send like a generic, email saying that, hey, this is my company, and would you like to invest, or would you like to take a call? I would do a little bit more research, go into the fund's fund's website, look at what sectors they are focused in, what are their prior investments, and then send them an email saying that, hey, you've invested in the biofood space, and I'm building something adjacent to it, something similar to it, maybe something different to it, something competitive to it. That just makes us feel that you have done a little bit of research, and it's not like a generic email that you've been sending to all other VCs. I think that's very helpful. And then the third one is that if you're part of like an accelerator or a program, like Randall has like a great network, so you can leverage those kinds of connections to reach out to VCs as well. So I would say, yeah, the 3 big things would be, again, to get introductions from people in your network who know the VC, cold reach outs, and then different programs like accelerators, incubators, and the Israeli Economic Trade Fund.
Perfect. Thank you.
Cool. And I guess would like to dive deep into probably the most interesting part for you guys now, which is what are the top 5 things we look for when investing. And these are kind of things that we have come up with experience of investing in 45 plus years now of our general partners, and have now invested in over 11 unicorns. So I guess the first one is market size opportunity. As VU, that's the thing that we rely on the most. For us, it's very important to have a market size of over $10 billion plus. Then the founder's ability to execute, product market fit, and unfair and sustainable competitive advantage. And then what are some of the key metrics that we look for when we make our initial investment, and then also our follow-on investment. Sorry about that, I think. Yeah, so what is a big opportunity, and why do we care a lot about it as VU? So as VCs, we take in a lot of risk when we are investing in startups. So it's very important for us that if the startup is also even able to do 1% of what it says it's able to do, it's still a success. And if it's able to do more than that, we are able to make high returns on our investment, since it's probably the riskiest asset class that's out there. So again, going back to what a big opportunity is, what is a big opportunity? To calculate your SAM is kind of defined as it's a segment of the TAM, and it's targeted by your products and services and in which geographical area your product is based in. So it's kind of like the revenue model times the total targetable customers. And then what SOM is usually, as investors, we think of the 1% of TAM of SOM, or the 5-year revenue that the company will be able to achieve. So whenever we are creating like a financial model for a startup, SOM is something that we really care about. That's what we base our exit multiples on, that where can this company get in 5 years? And if it gets to that number, is that number going to give us a big enough return for us to make that investment? So even as startups, I think it's important for you guys to project this number correctly and then put it in front of VCs, so that, because VCs don't really understand your business as well as you guys do. So if you're able to feed this number to them, it's a lot easier for them to make a decision. And it also shows that you're able to think of your business in a very quantitative manner, where it's able to get returns not only for you guys, but also for the VC. The next big thing you guys would have, of course, heard is the founder's ability to execute. So, it can be a great founder who is very, very technologically smart, but that's not the company that VCs want to invest in. VCs want to invest in the company that is able, that the founder has, certain advantages, or even if he does not know, or if he does not have those skills, does not have that skill set, he's able to build up a team around him who's able to execute on those key criteria. So some of the criteria is able to tell a great story. If you're building a consumer product, I think it's very important for you to build a brand, not just a product. So the craft of being able to tell your story to the world, I think that's very, very important. That's also very important for the third point, which is ability to raise capital. If you're not able to succinctly tell your story and tell what motivates you to start to build that startup, it's going to be very hard for you to raise capital. And a lot of the times, the companies that win are not the best teams, but the teams that are able to raise capital from investors, who are able to last that journey for by raising enough capital. The ability to attract and hire a top team, I think, is very, very important when we evaluate our founders. Ability to generate revenue. You can build a great technological product, but it's very important for us as VCs for to be able to see that you're able to sell the product. So a lot of the times, VCs will get on a call with the founder when he's pitching to a potential customer, and see how he presents his startup to his customer and how he's selling it. Because again, like I've mentioned it like multiple times now, it's not the technology that wins, it's not the people that win, it's the ability to execute, and a big part of execution is able to generate revenue. And then scaling and dynamic thinking, of course, that's hard to evaluate by just talking to the founders a couple of times, but that's something that we keep in mind when we are looking to make the final decision.
Awesome. We have a few questions here in the chat.
Yep.
One from Sebastian. It says, is the $100 million, is that the minimum expected SOM that should be attainable in 5 years as a threshold for investment?
Yeah, so it's not I'll go back. So it might not be a threshold for every VC. It is a threshold for us. And that's because of the reason that let's say if the company is able to get 100 million in 5 years and probably gets a 7 to 8x revenue multiple on exit, that's a $800 million exit. right? So that's kind of minimum what we're looking for. We want to invest, like every investment that we make, we want to see the potential of it being a unicorn. Of course, we understand like 70% of our companies are not going to be a unicorn, but at least they have to have a potential of being a unicorn. So when you get into the $100 million plus revenue, the revenue market, then most companies are going to get like 5 to 15 times the revenue multiple, which puts them in the unicorn status. And so that's what our threshold is for investing. I hope that answer was clear.
Awesome. And then there's a second question specifically about ag tech. And the question was, can you elaborate on your approach for agri-tech startups? What are your parameters, et cetera? I know when I was there, we invested in Bear Flag Robotics, which was an ag tech startup, but I'll let you talk about this one.
Yep. No, exactly right. That's what I was going to bring up. So we've invested in Bear Flag Robotics, and we've looked at a lot of companies, even when Randall was there, that were like picking apples, from farms, or like transportation or logistics in agriculture. I think there's no specific evaluation criteria that is specific to agri-tech. Since we are an agnostic fund, we only have limited amount of capital, and we're going to allocate that capital to the best company, not necessarily, we don't have any mandate of investing, X amount in agri-tech or X amount in bio-inc or anything of that sort. So like some of the criteria that I've mentioned here. So even if it's an agri-tech company, we want the SOM to be $100 million plus SOM. We're still going to evaluate the startup or evaluate the founder in similar vein. And even the points that I'm going to talk about later in the presentation, it will remain agnostic of whether it's an agri-tech or any other business. But yeah, I think just on the agri-tech point, I think it's an interesting space. It's a growing market. There's a lot of historical technologies that are still being used there, historical practices that require a lot of, disruption. So if you're able to bring that up to a VC and able to pitch that, I think that helps a lot. But I think on the evaluation criteria, you're going to probably be evaluated the same way as any other startup that we see.
Awesome.
Cool. So I spoke about the founder's ability to execute. And then I think this is probably the main point for us, which is an unfair and sustainable competitive advantage. And a lot of founders that we speak to, I think are not clear on what is an unfair competitive advantage and what is an unfair and sustainable competitive advantage. And I wanted to spend some time here. So for example, like an unfair competitive advantage would be, the location that you're based in, or you have investors with deep pockets, or, you're manufacturing your product in Bangladesh or India or, Southeast Asia. So your cost of labor is very, very low, or your speed of production is high. I mean, these are great advantages to have, but these are not sustainable advantages. Like any other company in your sector or one of your competitors can definitely go out and move its production to Asia to reduce its labor cost, or increase its speed of production, or hire a better team, or find or get an investor that has really deep pockets. These are great advantages to have, but these are not sustainable and competitive advantage. Another big people think that it's a competitive advantage is the first movers advantage. And when we were working together with, like when Randall was working with me, this is something we heard a lot of companies talk about, that hey, we are the first ones doing this. But that's not really unfair competitive advantage. You can think of MySpace, can think of Orkut, and when Facebook came, it kind of disrupted both of those. There are a lot of other industries that happened. So being a first mover is not really a competitive advantage. Having patents is not really a unfair competitive sustainable advantage, because you can tweak such little things in patent and then build a product that's similar to what you already have. So we would deem it as an unfair competitive advantage, but not a sustainable competitive advantage. So what are some of the sustainable competitive advantage? One is brand, right? Like how do consumers look at your brand? For example, like Google has gone from being a noun to being a verb. So that's a unique perspective on what we have on Google. And so we want to invest in the brand, not just the product. Having network effects is really can be a sustainable competitive advantage. Um, I think a big sustainable competitive advantage is that do you have access to something that others in your industry might not? Maybe a certain form of data that you are able to, that you have gathered over 10 years of research, or because of you being positioned in a particular place, you having access to particular kind of resources, or maybe financial data or understanding of that financial data that is proprietary to you. That is something that is sustainable competitive advantage. Um, so it's very, very important when you pitch to a VC to clarify with them, what is your sustainable competitive advantage and why you are going to be the winner in the long term. I think I think some other things that we look for are some key metrics, and these kind of come into play when we make our follow-on investment. Because when we make our initial investment, these metrics are not always clear. But when we are able to track you for about 12 to 15 months, and when we are making a follow-on investment into the company, we are definitely able to track where your where these key metrics were. Sorry, let me just drink some water.
Yeah, it's also important to know that it obviously it varies by industry and in stage of company for all these different metrics. So just because you're a pre-revenue company doesn't kind of exclude you from getting looked at from a VC firm as well. It's just important to know. Sometimes it takes times before you kind of build that pipeline and that customer base. But I'll pass it back to you.
Yep. Yeah. No, I think that was a great point. I think these metrics are sometimes industry specific, sometimes state specific, but these are just there just to give you a high level indication of what as VCs we look for. For your particular industry, there might be a particular metric that's specific to that industry, and so that's something that we would like to focus on. So just but on generally, capital efficient businesses are always great for VCs. For example, I had mentioned a company called Flarco, which is one of our portfolio companies. That company, when we invested, had 0 million AR, like it was pre-revenue, and it raised about $10 million, did not spend even $1 on marketing, and reached to about $22 million in ARR. So it has great capital efficiency. And so when we look at those kinds of metrics, it's easier for us to make a follow-on investment into that company just by the virtue of the way these metrics are progressing. Revenue growth rate and user growth rate are also very important metrics. Of course, like when your base is very, very small, when you have like 10 customers and you're going to 50 customers, that growth rate is not really that important. But as you guys scale, especially when you get to a Series A, Series B stage, revenue growth rate and the user growth rate becomes a key metric. Retention, low churn rate. This metric kind of signifies how consumers are using your product and how sticky your product is, because the growth rate can be it can look very high if you have a high marketing spend, but a low churn rate kind of signifies that you are doing something good with the product. The customers really want your product. They've been using it month over month, year over year, which is always a positive sign for a VC. And then finally, what is the key value proposition? Are you building better quality than the competitor? Are you faster than the competitor? Are you cheaper than the competitor? There has to be something in your business that clearly differentiates you from the other founder, whether it's your go-to-market strategy, whether it's something that you have unlocked that is special, that only you have thought of, and no other VC has thought of, or no other, startup has thought of. So be very, very clear to the VC on what your value proposition is and how you're going to overtake the market from your competitors. And then I know it's not very clear here, but I just wanted to give a quick sense on what the decision process for a VC looks like, right? So you start by sending your deck to the VC, which is here. So as a VC, I would review the deck. If I'm interested in the deck, I would set up a meeting with the founder. And so since the first impression of you or your company is the deck, I think it's very important for you guys to make sure that the deck is in the prime shape that it can be. So yeah, it's definitely a very, very key point. Once we review the deck, we'll set up an initial meeting with the founder. Once we meet with the founder, typically all of the three boxes, the yellow boxes that you see here, are internal meetings that we have where we evaluate the founder and the company at a high level. And the evaluation is not diving too deep into the key metrics, but just that, is there a why do I like the company, why do we care, and how does it make money? And if we get positive answers to all of those three questions, we then move forward and go to a partners meeting, which is probably like the pivotal stage for in the investment decision process for us when we are speaking to founders. If when we present to a partner and if it's a pass, the company gets killed right then and there. But if it's a yes, we then move to having additional calls with the founder. We'll dive into deeper due diligence of the company. We'll get access to the data room, and then once we pass that process, we take the company to an investment committee before the investment decision is made. And usually, I think a key thing to think about here is that when an investment decision is made, most VCs do not have a consensus approach; they have a conviction approach. So if you are able to sell your vision, or if one of the general partners at the fund really like what you build, you might be able to get through getting an investment from them. And so that's why, like, going back to the first slide that I showed, it's very, very important for you to understand who you're pitching to, what spikes their interest, as a general partner, like what have been their prior investments, what kind of companies like do they like to invest in, because that will really help, because they'll be a champion for you in the investment process.
Awesome.
And
I do have a couple questions on this last slide. Can you kind of talk about the pitch deck itself? What would make, because obviously that's the first impression after you potentially have that warm introduction. I'm sending you a pitch deck for my company. What makes it good? What shouldn't be included? What's sort of superfluous, or what are you really looking for? Like how many pages is too long? What's a general good one?
Yeah. So yeah, that's a great question. And, we can spend another hour on this, but like on a high level, it has to sell the vision of the company, how they make money, what do they do, what problem that they're solving, and who's the team. If these 5 critical questions are answered, or at least an overview of these 5 questions is in the pitch deck, it really helps the founder evaluate the company very, very quickly. You have to, I would suggest, like, having a very, very clean deck with as less text as possible, having like high level pictures, just describing, the key components of the business as the initial pitch deck that you send to the VC. Because VCs on typically, like, I'm a junior VC, and I, on my level, get about 40 pitch decks a day, from LinkedIn, from my connections, from other people in the VC industry. So it's very hard for me, and I have limited time. So it's very hard for me to go through each and every single pitch deck. And it's very similar problem for other VCs as well. So keep your pitch deck very high level. There are a couple of resources that I can share with Randall, and then he can send it to you guys on what a pitch deck should look like. What are some of the best pitch decks that are out there that you guys can look at and get some inspiration from. But again, to just summarize my question, keep it high level, keep it very, very clean, very in a very well presented format, and then answer the main questions. How do you guys make money? What's the problem that you're solving? What is your solution? Why do I care as a VC? And who is the team that's behind building the startup?
Awesome.
And
awesome. I'll take the presentation back here.
And then I'll also put in. So one of our general partners came up with a template which is known as like the best startup pitch deck. It's been downloaded over 500,000 times. A lot of great startups have been able to raise a lot of capital, getting inspiration from that template. So I'll put the link of that template here in the chat. But there is also a bunch of other resources that I can send Randall, and then he can share it with you guys.
Perfect. I'll definitely share that with a follow-up as well. Thank you for that. And yeah, really enjoyed the presentation. It was very insightful to learn and obviously revisit many of the concepts that I'm familiar with, but obviously to share that as well. I'll go ahead and start off with the question here, but I'll also give everyone here the ability to unmute themselves. So if you do have a question at this point that you were saving or that you just thought of, please go ahead and just ask that. But my first question for you would be, what's the best way if you secure a meeting to utilize that time? Should I just go ahead and just run through the deck? Should I really talk more about my background? What's the best way to kind of utilize that 30 minutes to 1 hour?
Yeah, that's again a great question. I think do a little bit of research on who the person that you're talking to in the firm, whether it's an analyst, whether it's an associate, whether it's a general partner. What are some of the investments that they have made prior in the fund? What excites them? Usually a lot of this information you can find just by going to the website or going over the LinkedIn. I think that will help set the precedence for the call. Every VC likes to take a different approach to the call. We have two general partners in the US. One is Sky, one is Andrew. Sky usually will ask the founder to run through the presentation slide by slide and will ask very, very quantitative questions during the meeting. Whereas Andrew has a very, very different approach. He likes to have a conversation with the founder. At times the conversation gets derailed and it's not even about the company, but it's just about the founder, like what excites the founder even outside the startup, right? So be ready for having that conversation. But in general, it's going to be the pitch deck. Have your high level numbers ready, like your revenue numbers, your sales numbers, number of users, go to market strategy, have the basics ready, and then let the conversation flow wherever the general partner or wherever the investor wants to take it.
Yeah, makes sense. Sounds like it kind of varies from person to person.
Yeah.
The approach, whether you're more quantitative, qualitative, et cetera. Yeah, absolutely.
Yeah. But also, like, this is a very fair question to ask prior to the call. Just send an email to the, to the VC saying that, hey, what do you expect from the call? Like, am I running through my pitch deck, or are we just having a introduction call? And then usually they will answer to that question. And then that will help guide the call as well for you guys.
Awesome. I'll open it up here to the floor if anyone has a question at this point. Go ahead and just unmute yourself, introduce yourself, and ask your question.
I don't think I did that great of a job that everything's so clear to you guys.
Yeah, everything was pretty clear. I guess, so do you have any, I know go ahead.
So sorry to interject. Hi, Arpan.
Hey.
Thanks for sharing the insights and the patience in describing things step by step. One question for industries like healthcare, where revenue ramps up slower than, let's say, SaaS or other industries. Do you have a different way of looking at it, or you're still expecting the 100 million-ish over 5 years?
Yeah, so that's a great question, right? So the 5-year number is not like a fixed number. Sometimes it's a 7-year number, sometimes it's a 10-year number. And we completely understand, right? We have healthcare companies that we have invested in at a pre-seed stage that are not even going to be able to generate revenue in the next 7-8 years. That is like if everything goes to plan with FDA approvals and HIPAA compliance and everything like that. So of course, that's not a rigid number, but that's like a framework that I was trying to show you guys how VCs think. But for healthcare, VCs like to think in milestones. So it's very, very important, I think, for you as a startup to show those milestones. Because let's say, like, if I'm giving you 100K right now um, in your pre-seed round, what is that 100K going to take you? Where is that, how are your milestones going to develop with that 100K? So you'll be like, hey, like, I'll be done with my round 1 testing and I'll be at round 2 testing when I go to raise my next set of capital. And so my valuation will be X times higher. Because one decision that VCs are constantly making is that, should I invest in this round or should I invest in the next round? And so to sell them on this round, it's important for you to sell the milestones that are going to improve from this round to next round, which is in turn going to increase the valuation in the next round. So it's better for the VC to invest in this current round. If there are no improvement in milestones, then VC, it's a clear decision for the VC to just go and invest in the next round. It's like less risk. I hope that answers the question.
Those are super. Thank you. So maybe 2 follow-on questions to that. I apologize to anybody else if you want to cut me off. One, what would be, if you're investing early on, I assume you're not necessarily expecting a jump, a 7 or 8x jump like you would on the exit of a company. So what would like a rule of thumb there be? And 2, how do you see product market fit developing? Because that typically means you have to start selling and then you reach product market fit. It doesn't happen before.
Yeah, so I'll answer your second question first. So on the product market fit, maybe like on the healthcare space, we want to invest in the market need and not the market want. And that's how we evaluate the product market fit. And by what I mean by the market need versus market want is that if a product is a nice to have, that's not very exciting to us, at least specifically to us as a business, because things can change, the market can change, and then your product stops selling. But if it's a want, right, like if you're solving a clear problem, that's kind of a market fit for us. If you're able to solve cancer, I mean, that's a market fit, right? Like it's a clear problem that exists and you're able to solve that problem. Versus if it's an incremental incremental betterment, like to an existing solution already out there, then the evaluation process becomes that how important is that incremental evaluation, right? Like if for example, like if you're able to diagnose someone within 3 minutes instead of 5 minutes, that's not very helpful. Like it's better, no doubt, your company is better, but is that an enough incremental improvement for people to start using you guys versus the competitors, right? So that's how I guess we think of product market fit. And then coming back to on your first question on the revenue multiple, I think it's independent of when the company exits. Revenue multiples are kind of set by the industry itself. Like, fintech company like MasterCard have a revenue multiple of like 17x, 20x versus a revenue multiple of like a space company like Made in Space that was 3D printing parts in space was about a 5x. So we have frameworks, we have like literature around where we think the right multiple for the company could be. For healthcare, it's usually on the higher end. And that's how we kind of evaluate our investment opportunity. Also, like the revenue multiple is not something that I like as a startup, you guys should focus on, but more focus on like how big the company can get in terms of revenue or in terms of EBITDA.
Super, thanks a lot.
I want to ask something, please. Hello, I'm Dan from NeuroAudit, and thank you for the introduction. I want to ask if there is any ecosystem for brain technologies. Actually, we always talk about healthcare, but brain technology and brain tech for brain disease or brain disorders is really side technology. Is there any ecosystem or investment around those skills?
So I think you said brain technologies, like
yes.
Brain tech? Okay, got it. Yeah. I mean, unfortunately, I am not aware of any VC that particularly focus on brain tech. I think it comes under the umbrella of healthcare. If it's a healthcare VC, probably they look at brain tech. And the sole reason for that is that how big is the brain tech, market? Like, is it $100 billion market? Is it $1 trillion market? If it's not like if it's less than like $100 billion market, usually it's going to be very hard for you to find like a ecosystem just for that technology itself. It's usually going to be a sub vertical under a different sector, which is usually going to be healthcare. But yeah, I mean, brain tech is definitely picking up. We've seen a couple of companies even recently that were solving problems in that space, and also like building new technologies that are more innovative in the brain tech space. So definitely a growing industry, but and at least I don't know of any ecosystem that particularly focus on brain tech.
Thank you.
We do have a question in the group chat, and then Aziz, I'll let you go right after this one. It says, how do you see investing in international startups that are not yet based in the US?
Yeah, that's a great question. So we are agnostic of geography. We've invested in Europe, South America, North America, Asia. Usually, at times, only funds who have mandates from their LPs to invest only a particular geography location, only those funds are constricted. But otherwise, most funds who are even based in the US are probably open to investing outside of the US. But it's again, like, it's based on VC to VC. So probably like just better to ask them, clarify with them that, would you be open to investing in a company outside of the US? I know like it's very, very fluid to invest in Israel, at least for US investors. So, investing in an Israeli company is not a problem at all. But also if a VC says that, no, they're not able to invest, you can always just create a C Corp based in Delaware to take in the investment.
So my question was, my name is Ziv Kinan. I'm the CEO of Symmetry. We are digital securities exchange out of Israel. And my question was about traction. Like, what is traction to you, and what does come back to me after you have more traction, like would mean for a VC?
Yeah, that's when VCs, if I'm being very blunt here, when VCs say that come back to me with more traction, it's the only reason is because they think that your next round is not going to be at a much higher valuation than the current round. So if I come into your next round, I'm just de-risking myself, and I don't have complete trust in your product just as of now. So it's not about traction, but it's just about trust, and it's about the fact that they probably think that you are going to be at probably around the same level in terms of valuation in your next round. As VCs, we want to invest if we want to invest at the apex, where at the cliff, right? Like as soon as you invest, then the valuation goes from 10 million to 60 million because they're able to hit X amount of traction. So that's one thing. And then on your former question on what is traction, and like every traction for every single company looks different. If you're a company that has already built the technology, the traction for us is that how are you able to sell to those customers? How many customers have you already acquired? And sometimes like getting 50,000 in revenue is not really revenue. You want to see that culmination of getting those big contracts and long-term contracts. So if you are getting traction in terms of revenue, I would say that show your traction in terms of like low churn, low sales cycle, like a smaller sales cycle, low churn. Just basically show that the customers love you and they really need you, and it's not like a want for them, it's a need for them.
All right, we're gonna do one last question just due to timing. It's right here in the chat. So it says, what is your typical investing model? Are you investing in equity? Is it a safe round? Is it debt? What would that be?
Yeah, so we don't do traditional debt. Like if you mean convertible notes, which is a form of debt, we'll do convertible notes. But we are agnostic of, again, what kind of investment we make. We've invested in safe, We have invested in convertible notes, equity rounds, and we are also at times open to doing secondaries, though we have not yet done it with this fund. But yeah, I mean, I think most VCs don't really have a mandate on like what kind of like equity, what kind of investment round is it, unless they're leading the round. But for early stage startups, I think, raising at a safe is probably like my personal recommendation, at least, because it's the cheapest for the founder, it's the quickest, and you don't really have to hassle too much over the valuation.
Awesome. Perfect. In case you guys do have more questions, here's my contact information. I will definitely share Arpan's information as well, so that you can directly talk to him about doing that. But I'm very glad that everyone here joined our conversation. Again, if you have further questions, Arpan just put his email in there, so definitely shoot him off any of your questions or comments about today's presentation, anything about the fund or just VC investing in general. And of course, you can contact myself. I'll go ahead and put my email in the chat as well. But again, it was fantastic for everyone to join us here today. I really appreciated everyone contributing to the conversation, including at the end. I know there could be some unanswered questions as well, but please contact us if you do have more questions or comments. We're very open people. We give a lot of honest feedback. We try to be as helpful as we possibly can. I know my organization, we're just here to really help you guys, make those connections and succeed, make those next steps. So that's really the important thing for us. And I know as a VC investor, including with Arpan, they want the same thing. They might be a little bit choosy about what they ultimately invest in, but they'll still give you some feedback in case you didn't make the cut, so to speak. Definitely worthwhile to reach out for that. But yeah, so that sort of wraps up today's events. If you were picked for the one-on-one sessions, please stick around and I'll create a separate room for you guys. But again, the recording of the events will be sent out afterwards. I will just go ahead and wrap that up. But thank you, and hope you guys have a great rest of your day or evening, depending on where you are. Thank you.